Welcome back. With an improved operational performance and the favorable gold price to the smelter, this combination is what has driven a more than doubling in Goldfields' annual headline earnings per share. Shareholders are smiling all the way to the bank too. The final dividend has also been more than doubled, and adding shine to this, shareholders also get their share of a special dividend of around 4 billion rand, along with a buyback as well with shares. Mike Fraser, CEO of Goldfields, joins us with his assessment of the commodity supercycle, how it impacts the numbers and also the way forward as well. Mike, hi, good to chat to you on Business Lunch. I mean, it's been a phenomenal year, phenomenal results. You've got to be celebrating at the moment. Take us through the past year.
Oh, look, thanks very much, Ryan. Good to chat to you. Look, I think for us, we're very proud of the achievements of our entire team across the board for our 2025 contribution. I think first and foremost, what was really pleasing is we made significant progress on our safety journey. And that was really something that we feel good about, that everyone was able to go home safe and well at the end of every day. But I think just to talk to your point, I mean, we have seen an 18% increase in our production year on year. Part of that was the ramp up of our Salares Norte mine, but equally contributions from South Deep, our Australian operations, really helped us to lift production. And that helped particularly in a rising gold market where we see gold prices, the basket on average, 45% up year on year. And that leverage that we saw with a high gold price, high production, and a good focus on costs meant that we were able to see a five-fold improvement in cash flow from our business. And because of that, we were able to then deliver additional returns to our shareholders. So a good year all around. We're not getting caught up in the hype of good gold prices, but certainly there's nothing that tells us, given where the world's at, that we are going to see a big retreat in gold prices for some time. And that sets us up in a good position to invest for the future as well.
You see, that's the big worry as well. We spoke to DRD this week, and the question I asked them, and I'll ask you as well, this is great. Today, the gold price is at $5,019. I checked a short while ago. That could go down again. Are you preparing? Are you saying to yourselves, look, let's play the longer game here?
Absolutely. So everything that we do is focused on investing for the future. Goldfields is a company that has its genesis over 138 years ago. And certainly the one thing that weighs on us is to make sure that we're investing for the future. So at our Capital Markets Day in November, we made it, the capital allocation framework is a really key part of our strategy to make sure that we invest in our assets today, to make sure that they're safe, reliable, and continue to deliver future performance. But equally, we invest for the future. So things like bringing on our Windfall project in Canada is a really important project for future generations. And then thirdly, we want to make sure that we utilize these high cash flows to reward shareholders that have walked the journey with us. And I think it's only by being very disciplined in how we balance those tensions and capital allocation that we are able to create this future sustainability and keep investors connected to the sector. But I do think, coming to the point on price, the way that we plan our business certainly is not on a $5,000 gold price. If you look at our reserve price, we actually did lift our reserve price last year because we saw this major disconnect with long-term prices. So we lifted our reserve price to $2,000. That's where we kind of plan our long-term business. But equally, we plan short-term around consensus, which is around $3,300.
Okay, you see, now that's interesting. Looking at some of the headwinds, I mean, electricity prices, are you going solar? Are you looking at something else just to get around that? Because that is very expensive.
Absolutely. And I think what's important for us as we think about the investment in renewables. So today, 18% of our energy requirements are provided through renewables. We have two significant renewables investments. We have a 50 megawatt solar plant at South Deep, which we are now looking to expand. That's a significant internal opportunity to expand that. We are also investing just under $300 million in a microgrid at our St. Ives mine in Western Australia, which will give us 70% of our energy from renewable resources. And these are all investments that are significantly value accretive and deliver good returns. So we'll continue to look for those opportunities.
Yeah. What other expansion projects do you have? I'm also talking about Australia. Are you looking at expanding there as well?
So we will continue to look at opportunities to improve our business there. We added the Gold Road acquisition last year meant that we essentially consolidated ownership of the Gruyere mine, the other 50% we didn't own. But we are deploying quite a bit of capital in looking at opportunities to extend life of our assets. So at two of our core assets, St. Ives and at Granny Smith, we are investing in material handling systems that will enable us to mine deeper and to reduce the cost of mining.
Gosh, that's so very interesting. So going bigger and bigger and bigger while being a little bit cautious as you go.
Absolutely. And I think that firstly and foremost, we always make the point that quality trumps size. And so for us, we are confident about incremental growth in our portfolio, but improving the quality of earnings, so growing cash flow per share on a relative basis, and being disciplined in how we allocate capital is how we're going to compete for the long term. It's not about size for size sake.
Yeah. Talking about that special dividend, I would think that shareholders are raising a glass to you. Was that expected?
Oh, so what we did do, Ray, again, I'll go back to November when we revised our capital allocation policy. We also changed our dividend policy from a percentage of normalized earnings to a percentage of free cash flow. So we committed to paying 35% of free cash flow. So the base dividend increased quite dramatically on its own. You know, the final dividend was 18.50 Rand. But we also did in November said that we would allocate $500 million for additional returns over the next 2 years. Given that gold prices continues to remain strong, we have paid out $250 million of that in a special, and we've paid $100 million, which we're going to put towards a buyback program. So that, and in addition, we are considering additional $250 million top up on that program. So hopefully our shareholders seeing us as being disciplined in rewarding shareholders along the route. And the last point I'd make on that is that delivers a free dividend yield of around 6.3%, which places us really at the top end of our peer group.
Yeah, it certainly does. Congratulations. Those are lovely numbers. Mike, thank you so much for chatting to us on Business Lunch. I do appreciate you taking the time. Thank you. That was Mike Fraser, CEO of Gold Fields.